Here I'm very happy to present to you the former governor of the National Bank of Serbia, Mr. Radovan Jelicic. You have the floor.
Thank you, Mr. Voshnak. First of all, I would like to thanks to the organizer for inviting me when actually I confirmed in March last year as was still an acting governor. But I thought it's my obligation once I promised, even if I'm not governor, you know, I should come and I should make my presentation. But in addition to that one, there is also one additional reason. I mean, some 20 years ago, I was sitting on the other side. I remember I came first time in my life to a conference to Passau. It was 1990. It was August. And it was organized, again, by some people, just like organizing the Columbus Forum. And trust me, that time I had no idea that 20 years later I'm going to be already an acting central bank governor after serving a 6 + 3 years term. So just want to give you, so to say, a hope that hopefully in 10, 20 years you are going to be one of those people who did something, who had some positions, and you're still looking forward because you're still relatively young to face some new challenges. So all in all, I'm pretty jealous what chances you will have in the next couple of years. The presentation is about Serbia, but I think it's very important that when we look to the numbers, just by changing with a couple of percentages, it can be applied to a lot of other countries in the Western Balkans and even to some of the countries in Central and Eastern Europe. First of all, what happened in all of these countries after being more than 40 years on the other side of the Iron Curtain, it's a huge consumption started. I gave you here a concrete example of Serbia. You see that average wages basically exploded in Serbia during those last 10 years because we started our transition process, of course, much later than anybody else. So we started from some 90 euros, went up all the way to 400 euros. Of course, what people do with the money, if you give them the money, they spend it. Yeah? In addition, pensions also increased. I showed here an example, you know, how much money was spent from the budget in order to provide and increase the level of pensions. Then you had the foreign direct investments. In Serbia, record year of 2006, 3.3 billion euros. Altogether, some 12.3 billion euros. Of course, all the investments that come to Serbia, what happens to that fund? It is spent. What happened to foreign debt? Foreign debt was also increasing substantially. You can see the upper part is actually the public debt. The public debt constantly reduced, not because we prepaid our debt or repaid our debt. The public debt was reduced because we agreed with Paris Club and London Club. But the private debt, as you can see, exploded as well. From 2.3 billion, it went up all the way to 15.5 billion euros. Not only the debt of companies increased, but also the debt of private individuals. As you can see, the indebtedness of the citizens toward the banking sector, which was basically non-existing in 2001, average debt 12 euros per citizen. That was more of a sign how people did not use banking sector at all, but it went up to some 600 euros. So what happens when you increase wages? What happens when you increase pensions? What happens when a lot of money comes to Serbia because of foreign direct investments? When we increase our debt toward the banking sector, when you increase your debt toward, when you get more loans from abroad, of course people spend it. And if you spend all of this money, of course GDP must increase. As you can see, in Serbia, the GDP increased in average by some 6% in the time period between 2001 and 2008. What was actually a reason for concern, but nobody was really so much concerned, if you see that middle part, the blue one, which is called services. So basically, the GDP did increase, but almost some 80–90% of this increase of GDP was only services, meaning non-tradables. So People use more than mobile phones. People use more banking services. There was more construction. So all of this increase that we had in Serbia was basically based on so-called non-tradables, so we cannot export it. And of course, all of that was supported, as I already mentioned, by increasing the debt, by increasing the pensions, and by increasing the budgetary support specifically for the pension fund. Of course, if you spend more, it also has a very negative effect on your current account deficit. So if you can see in 2001, our current account deficit was some 2.5% of GDP. It went up all the way to 18.1. If you look to the absolute figures, they are staggering. I mean, from 300 million, you go up to some 6 billion euros. And you know what? The politicians thought, but you know, we discovered here the perpetuum mobile. I mean, we are borrowing money, foreign bankers are providing us money. Let me just give you one example. Some 4 years ago, when the Telekom of Republic of Serbia wanted to buy the Telekom of Republika Srpska, we paid a margin. I mean, that's public company in Serbia paid a margin that today Greeks can only dream about. Yeah? We were that time a double B- country, and Greece is today, I mean, an EU member and, of course, an EMU member as well. So basically, there were absolutely no punishment for not being a member of the club. Once more, a substantial increase of the current account deficit, but let me tell you the following. Once the crisis hit, and it did hit us very strongly, you can see that current account deficit went down from 6.1 billion euros all the way to 1.75. And I can tell you only one thing. It was much easier to finance the 4.6 in 2007 and the 6.1 in 2008 than to finance the meager 1.7, 1.8 billion euros in 2009. From a very simple reason. You had no problems borrowing on the market. You had no problems to convince the Austrian, Italian, French banks to bring fresh money in the time before the crisis. But of course, we had a huge problem how to find enough financing even for that 1.7, 1.8 billion euros. And for us, the decision was to go to the IMF and ask them for money, ask them for a program that would actually finish in April next year. Coming out of 40 years of not economic stability, I mean 40 years economic instability, constantly high inflation, not a lot of confidence in the local currency. Our system is still rather highly euroized. There is still a saying, you know, what is a Serb doing if he has no more dinars in his pocket? Yeah? The answer is he changes 100 euros. Because everybody has 100 euros in his pocket, but the amount of dinars he's keeping in his wallet is always limited. So we knew that our system is highly euroized. Even today, private individual savings, some 96, 97% of private individual savings are in euros. But we were thinking, you know, how can you make our macroeconomic system more resilient? And we decided, despite this high level of euroization, to have a floating exchange rate. Floating exchange rate is actually something that not a lot of countries are practicing. I mean, if you look to the former Yugoslavia, Serbia is the only one where you have a really floating exchange rate. We call that managed float. I mean, a lot of other countries use managed float regime, but they are mainly managing and less floating. Yeah? While in our case, I mean, it's definitely more floating than managing. Let me just give you an example. The exchange rate before the crisis was at a level of 76. Now the exchange rate is approximately 107. So does it make actually the central banker the most popular person? Because then the politicians come and they say, you know, the average salary, of course, got reduced substantially, measured in euros. And of course, the average salary in Serbia is today actually even lower than in Montenegro or in Macedonia, than in Bosnia. So once more, for politicians, it's not the most appealing selling proposition. But on the other hand, you know, it does bring you and it does provide you a competitive advantage when it's about the cost of labor is concerned. So once more, we decided to go for a floating exchange rate despite the fact that we have a high level of eurization, but we did know that we need, in order to have a stable system, a high capital adequacy ratio. In the case of Serbia, it's 23%. Just give you a short story here. Of course, we have seen that consumer credits are increasing like crazy, and we were just wondering how can we stop it. Of course, consumer loans, I mean, basically, as you can see, I showed this previously, there were no loans in Serbia to private individuals. So the bank started to offer consumer loans to private individuals, and we were thinking, how can we stop it? And then we came up with a measure, let's limit the level of loans to private individuals to the level of capital. So we put there an artificial ratio of 1 to 2, meaning private loans to private individuals cannot be more than double the capital. So we thought after this one, banks will say, no, we are then going to prefer to give loans to corporations, to SMEs, and to other areas. But then we were surprised as banks say, okay, we are going to increase our capital, because that's the other part of the equation. So basically, banks substantially increase their capital. I just heard here the name of Herbert Stepić from Raiffeisen and many others. They're all complaining, but they were increasing the capital. And of course, they were telling, that Serbia is not attractive because they have to bring so much capital to Serbia. But they knew the rules of the game. It's 1 to 2, and if you don't want to increase your capital, you still have an opportunity to provide more loans to to companies and to the SMEs. So because of that one, we had once more a very high capital adequacy ratio, what came very, very handy once the crisis started. We had very high and differentiated FX reserve requirements. So if our banks borrowed from abroad, we took some 40% reserve requirement for them, and only 60% they were able to on land. And of course, we used also very high interest rates, so that's made the attractiveness investing in local denominated papers very attractive. So this was basically the buffers that allowed us, once the financial crisis hit, to be one of the rare countries, if maybe not the only one, where the taxpayer did not have to put in even a single dinar or even a single euro in order to protect the stability of the banking sector. So once more, why did we need a large buffer? As I told you already, because of historical background, because of the flexible exchange rate, because we knew we are not Hungary, we are not Romania, who can call up Brussels, who can call up many other big brothers, and who will provide them, 15, 20 billion euros. We don't even have we did not have a candidate status. Now we got it actually yesterday. Yes. And last but not least, we had a low level of understanding. Serbian taxpayers were telling, why should we help those French banks? Why should we help those Austrian banks, etc., etc.? And, it, of course, still is a problem to explain to people, that those banks are Serbian banks. The only difference is that the majority owner comes from Austria, but they are once were Serbian banks. And the buffers I already explained to you, what we used in order to make the system resilient. When you look to the ownership structure, foreign ownership represented some 23% in 2003. It went up all the way to 74.3%. And out of this 74.3% foreign ownership, they're all coming from the EU. Yeah? So I used to say that the banking sector of Serbia already entered into the European Union if you look to the ownership structure. And of course, as I mentioned, it came out very handy once the crisis hit. And the state ownership got reduced from 49% to 75%. And the state, of course, was supporting their own banks, but once more on a very selective basis. Counter-cyclicality was highly praised today, although it was heavily criticized during the boom years. Yeah. Just had now a conversation with somebody, talking about the fact that now everybody